Good morning, ladies and gentlemen. I trust that you've had a very insightful morning so far, and thank you, iFAST, for having me. My name is Jo-Ann Chia, and I'm a Senior Portfolio Manager with Nikko Asset Management. Just to share with you a little bit about my firm, Nikko Asset Management is one of the largest asset managers in Asia, with assets under management of over 200 billion. So our head office is in Japan, Tokyo, and we have presence in 11 countries worldwide. For our Singapore office, we acquired DBS Asset Management back in 2011. And so the Singapore office is the largest center of excellence outside of Asia. Now, as we enter the second half of 2023, I think it's a great time for all of us to be taking stock of our investments. And so I'm very excited to be here today to be sharing with you why I think 2023 is a year for Asia fixed income to shine. Now, earlier outside the booth, I've had a chance to chat with some of you. And in my conversations with my clients, here are the 3 key investing questions for 2023. Will interest rates continue to rise? Is a recession coming? And of course, how should I invest my money? Now, in fact, all the 3 questions are interlinked. And today, our aim is to get a good sense of what to expect going forward and to understand why Asia fixed income is a space to be invested in. So in the comic here, you can see that the Fed, which is the US central bank, is trying to hit the inflation target but keeps missing. So what's going on here? If we take a step back and think about how we got here. Back in 2020, we had COVID. And then businesses had to shut down, factories had to close. And central banks globally had to cut interest rates to try to stimulate the economy, try to make borrowing cheaper. But then these closures also meant that when the economy started to reopen the following year, there was not enough production inputs to produce goods. And so this led to a rise in production costs and essentially a rise in selling prices. So we get inflation as a result. So this led to higher food, higher electricity, and higher prices of coffee. That's why we all come here early for kopi this morning, right? So anyway, with higher prices, central banks had to reverse the action and raise interest rates to try to bring inflation down. And so since the start of last year, the Fed has raised interest rates by 5% or 500 basis points to try to target inflation. So I think where we are now, 2023 is definitely a year for Asia fixed income because I think Asia fixed income is a very attractive class for us to be invested in. So the first question we'll be asking is, why now? First of all, with interest rates hikes, this brings lower inflation and also slower growth. And that's what we have already been seeing even here in Singapore. So it's safe to say that the rate hikes are soon coming to an end. And secondly, with higher interest rates, there are winners and there are losers. So the losers will be those who borrow money. For example, like us who pay mortgage, our mortgage cost is getting higher. But with higher interest rates, the investors tend to benefit because by investing in bonds now, the yields are more attractive. So Asia credit yields are more attractive right now. And also towards the end of the rate hike cycle, the US dollar tends to weaken. And that is when Asian countries and currencies, in fact, would stand to benefit. So I'll be talking about these 3 points in my subsequent slides. Okay, first of all, you can see that with the rate hikes on top, the inflation has in fact come down. However, this inflation rate is still above the Fed funds target. So the Fed probably has to continue to hike about 1 or 2 more times. And if you look at the chart below, the yellow part shows the increase in the Fed funds rate. And this is the rate that the US central bank controls. However, long-term interest rates, which is the blue line on the bottom chart, the 10-year yield shows that it has been pretty stable over the past few months, even as the Fed funds rates continues to increase. And why is that so? Basically, long-term interest rates like the 10-year yield reflects outlook of the economy. So with slower inflation and slower growth, yields are likely to come down. And this is also seen in the Singapore savings bonds average yield. As we know, last year, the average yield at end of December was about 3.57%. And the latest cutoff for July this year was barely 2.82% on average. So in fact, long-term yields has in fact already started to show signs of stabilization. Now on the next slide, we shows that Asia credit is attractive. On the top chart, you can see that the average yield is about 5.6 to 6% currently. And this is above the mean of 4.1%. And just 2 years ago, the average Asia investment grade yield was barely 2+%. So right now is really a great time for investors to take advantage of this and lock in yields and potentially enjoy capital appreciation when the rate hike cycle turns. Now below, it shows that Asia credit, which is the Asia investment grade credit, which is the dark blue line on top, has a more attractive spread compared to developed market peers in the US and the Europe. So this slide shows that on a historical basis and on a relative value basis, Asia credit is in fact very attractive. Now besides Asia credit bonds, we also like Asia local currency. And this refers to government bonds that are denominated in peso, rupiah, rupee, and other Asian currencies. On the top chart, you can see that emerging market Asia offers positive real 10-year yields. And these real 10-year yields refer to the 10-year local government bond yields of each country minus the inflation in that country. So that shows the real return that investors are getting. And this is positive compared to developed markets such as Japan, US, and Europe, where the real yields are negative, either due to higher inflation or lower yields to begin with. And besides offering positive real yields, Asia is really backed by strong fundamentals. As you can see in the lower chart, the IMF forecast for 2023 growth for China, India, and ASEAN 5 is about 4 to 6% for this year. And this compares with barely 1 to 1.5% in developed markets. So the positive real yields are backed by strong fundamentals, and therefore Asia local currency bonds are very attractive. So I've shared about why we are positive on Asia fixed income as a whole. But I do understand that as individual investors, it is difficult for you to construct your own portfolio and think about country, sector, currency allocation. So let us do this for you. Let Shenton Income do this for you. Now you see on this chart, investors are seeking stable returns amidst market volatility. According to the United Nations predictions, 1 in 4 people in Asia Pacific will be over the age of 60 by the year 2050. And this is triple the number since 2010. So this Straits Times graphic shows that investors have been turning to fixed income funds to look for to preserve their retirement income. And Shenton Income Fund is a dividend-paying fund that provides stability in the midst of market volatility. So here are the 3 key highlights of Shenton Income Fund. First of all, we provide regular income through monthly dividend payments. Secondly, we are absolute return focused, meaning to say we are unconstrained, we don't have to follow a particular benchmark. And this enables the fund to capture opportunities through credit, currency, as well as rates. And most importantly, we have a proven track record of delivering stable returns through market cycles. Now, this is a snapshot of the building blocks of Shenton Income Fund. Being absolute return in nature, we have the flexibility to get alpha opportunities through 3 engines: credit, currencies, and duration. So we invest in Asia credit, about 55 to 70% of allocation, as well as Asia local currency, about 30 to 45%. For the Asia credit portion on the left, this mainly consists of US dollar and Sing dollar bonds, and we invest both in investment grade as well as high yield. For Asia local currency, we take active FX positioning with the Singapore dollar investor in mind. And in terms of investments, we buy both our Nikko AM local currency funds for diversification, as well as directly through bonds. And active duration management is taken on the portfolio as a whole. So this is done as an overlay. We manage the portfolio interest rates on an overall basis. And so the fund aims to achieve a 4% annual return over the medium to long term, and we pay monthly dividends. Okay, Shenton Income Fund has had a long history, and our focus is on delivering stable returns in all market conditions. The fund itself was established in 1989 and has been through many financial crises and global market cycles. As you can see on the chart, the shaded areas shows times of crisis. And we went through the global financial crisis in 2008, the European debt crisis in 2011 to 2012, we went through COVID and several rounds of rate hike cycles. And what you can see is even though the fund showed a dip, the fund eventually bounced back and emerged even stronger thereafter. So I think now is a great time to be buying into the fund to participate in the upside when the rate cycle turns. So in terms of return, we have achieved over 260% on a cumulative basis, 3.65% on a historical basis, and year to date, we are up by 2.7% as of the end of June. So this slide gives you a sense of how we managed the fund navigating a very tough 2022. You know, just like in a game of soccer, the end goal is the same, to score goals, to win the game. But there are times that you have to play defense when your opponent is attacking, and there are times when you go all out to attack. So this is similar to how we managed the portfolio back in 2022. Most of the 2022 was a tough period. We had interest rate hikes, so it was a more defensive period. And in 2023, we started to take more action and be more active with the portfolio to get returns. So just to give you a sense of what we did, in the first quarter of 2022, playing defense, if you recall, the Chinese property market was in crisis after the default of the largest developer, Evergrande. So the fund then actively reduced our Chinese property exposure. In the second quarter, we had the Russia-Ukraine war, which increased the inflation even further due to higher food and energy prices. And that is also when the US Fed started to hike rates. So we reduced the portfolio duration to reduce the sensitivity of the portfolio to interest rates. In the third quarter, China remained in lockdown due to their zero COVID policy. And so we reduced our China exposure and property exposure eventually to zero. Now, in the fourth quarter of last year, we turned slightly more positive because we saw signs that inflation started to ease and global growth was going to slow down. So we increased the duration of our portfolio and we increased our exposure to investment-grade bonds because we think that investment-grade will be more resilient to a slowdown as compared to high-yield bonds. And into 2023, as I mentioned earlier, we think that the US dollar strength would start to fade. And so we're more positive on Asia local currency, and therefore we increase our exposure to Asia local currency. So just to sum up, this really shows how we navigate the portfolio in protecting the downside as well as participating the upside. Now, I'll just round up my presentation with some of the highlights of Shenton Income Fund. And this is the fund that I manage. Okay, I know the words are a bit small here, but the average yield of the portfolio is about 5.2%. The average duration is about 5.7 years. And the average credit quality is BBB+, which is investment grade. In terms of the top holdings, the first would be in our underlying Asia local currency funds that consist about 35%, and the rest are individual bonds. Now, in terms of sector allocation, after funds, we have banks and REITs, and these are strong names that we hold in our portfolio. In terms of country allocation, the largest would be in Singapore with about 26% allocation, and the rest is quite well diversified across 10 different countries. Okay, so this is my final slide, just to summarize the fund highlights once more. Firstly, we provide regular income through monthly dividend payments. Absolute return focus enables us to capture opportunities through credit, currency, and rates. And finally, having a long history and a proven track record of delivering stable returns through market cycles. So 2023 is a year for Asia fixed income to shine, and Shenton Income Fund is here to deliver. Thank you for your time. And please scan the QR code to find out more about our Nikko Asset Management funds, and do visit our booth outside and speak to us if you have any further questions. Thank you.